Hello, welcome to this training. My name is Ivan and I'll be the trainer for this lesson. This is a DBA for 2023 paper 2023. We are required to prepare the consolidated statement of financial position as at 31st December 2023. Our question reads: the following draft financial statement relates to each limited and its investment company as limited and A limited for the year ended 31st December 2023. We have PPE, tangible assets, investments, inventory, receivables, cash bank, ordinary share capital, retained profits, 10% loan stock, trade payables, trade overdraft, current tax, and then we told the following details relate to the acquisitions. A company may date the cost and the retained profits. It would seem that S is a subsidiary who they own more than 50% and A is an associate. So I will be consolidating S in full and accounting for A using my PP accounting. So I capture my information. First, I'll leave space at the top. To capture my statements. Given what I know now, I can capture just the labels of the statement and adjust them appropriately. So this will be still in shilling thousands. This will be the full statement. I will want to account for my investments, but then I know other than that, I want to have my goodwill. I know I'll have goodwill here. And another thing that is likely, because I have seen have my associates, I also have investment in associates. So these are elements that I will miss in the statement, and that's why we are able to come up with the values even without any calculation. This will be the same from this. This will also remain the same and implement some formatting. Then show me this. So then, before my total capital and liabilities, I also want to capture NCI. So this is just the statement. I have done no calculations. I have just adjusted it to account for the elements that you have to add. So then you can start my workings. Working one, which will be the group structure. I have H limited, which is the parents. H has acquired capital details about its acquisition of A and S. So the format of values is a bit differently. So if today is the 1st December 2022, we bought this in 2014. So we add S for 4 years, we bought it for bought it at the values of 200,000. We acquired 80%, so this is our subsidiary. Similarly, and capture information. Okay, it was acquired 1 year later. We have had it for 3 years. We acquired it for 300,000. We acquired it for 300,000. We acquired 30%. So this is our associate. We are also told H also invested in 25 million in stock of S in the past January 2021. So don't stock investment 25 million. I have also been told on the dates of the acquisition, the value of buildings is estimated and limited for 50 million and 25 million above their current amounts, being depreciated at the rate of 2% per annum and reducing values. So I have the building fair value gain at 50,000, here at 25,000. Will account for the fair value depreciation. The fair value of NCI can be estimated from the share price estimated at 8 shillings as of January 2019. So share price on acquisition shillings 8. This also implies that my value of NCI or my goodwill will impact both the present and the NC. I think I can use this information to set up my past calculations. Working through, after finding out my group structure, the next thing is to find my purchase consideration, which in this case is already given. Next, I should find my NCI acquired, my net asset acquired, my net assets are the sum of my share capital, the retained profit from the date of acquisition, and then fair value gain. So I'll have this for both S and A. We have the ordinary shares. For S and A, 500,000, 400,000. We had the retained profits on acquisition. S had 200,000, A had 300,000. Then we had the building fair value gain, where S had 50,000 and A had 25,000. So the total net assets is the sum of this value. So I acquired 80% of this and 30% of 720 value. After my net assets acquired, the next thing to find what to say will be my NCI of acquisition. So to find my NCI at a position, I will first find the number of shares in S, of which I had 500,000 as my share capital, and each share had a value of have 100,000 shares. Then what is my NCI percentage? If the parent acquired 80%, the NCI has 1.8%, which is 80%. Then the number of shares, number of NCI shares, which would be 20% of 100,000. Then finally, NCI acquisition will be 20,000 shares, which were each going for 8 shillings, giving a value of 160,000. With this now, I can find my goodwill. Working for goodwill. Goodwill also has a standard format. I want the goodwill for the group and the goodwill A limited. This will include the purchase, consideration, the net assets acquired, which should give us the goodwill, from which I should account for any goodwill impairments to arrive at the closing goodwill. So, for the group, how much did I pay? I paid 750,000, but then that also, I also had NCI of 160,000 on that date of acquisition. For A limited, I paid 300,000. How many net assets did I acquire? The net assets in X was 750,000, so equal minus this. But in A, I only acquired 30%, so equal minus 30% of my net assets, which should be a goodwill, for which I should check for any impairment. So I see here additional information on file that goodwill were relevant and impaired by 20% of cost at the beginning of the year 2022, and additional impairment of 50% of the initial cost was again reported in the year 2022. So we have a goodwill impairment of about 40% around that year. Which I will now use here at the bottom. So the equal minus 40% of 40% which I log of my goodwill. Then this, the sum of these two should give me my closing goodwill. Now beyond goodwill, I can go ahead and do all the other calculations. First calculation, I want the depreciation of fair value gain. So 125 fair value depreciation. Again, I want to account for both S and A. So I have the fair value in fair value gain was 50,000 A and 55,000 B. But then we are told this depreciates at a rate of 10% per, rather 2% per annum. So the current value, the current NBV of this will be 50,000 using 2% per year every year for a period of 4 years. And for A will be 25,000 using 2% per year every year for 3 years. Instead of going about it manually, I can use a formula. So be equal starting point multiplied by 1 minus 2%. I have not captured my building decision, so 1 minus 2%. But then I raise this to the number of years that are there, which is 4. So after 4 years of losing 2% every year, I'll have a value of 6. And so my depreciation will be this minus this. You can copy this across, but I will have to adjust this. Please remember, I have worked at A for 3 years. And so I can find my depreciation. So this will be reducing my retained earnings. So will this. I think that's it. Then additional information number 2. 1st of January 2021, H sold S an item in plant at the selling price of 75 million, reporting a profit markup of 50%. Plant is depreciated at 20% per annum on producing balance. So this is 2 years ago. I sold this to S at 75 million. So I have an amount of unrealized profit with the asset as sold outside the group. The unrealized profit given as a markup of 50%. But more than that, my plant is depreciated at 20% per annum, meaning I will have an amount of excess depreciation of my unrealized profit. Working 6. Unrealized profit on non-current assets. We have a selling price of 75 million. We have a markup of 50%. I have a depreciation of 20%. The first thing is to convert my markup to a margin, because margin equals to selling price, so the markup equals to cost. So my margin will be given by the markup divided by 1 plus the markup, which is 33%. So the unrealized profit is 33% of 75,000, which is 25,000. This affects my retained earnings. But then that also means that I have extra depreciation. So I have a unrealized profit of 25,000, but this was 2 years ago. I have to account for the 2 years of depreciation. So how much value have I lost? current NBV of unrealized profit would be, I have 25,000 losing value at a rate of 20% each year for 2 years. It should give you 16,000. And so your excess depreciation will be an amount of 25 minus 16, which is 9,000, which also affects maintain and then so I can mark some of my notes as used. This is used. This is also used. Same here. Same here. Then during the year, companies traded as follows. S sold goods at a selling price of 20 million each at the normal gross profit margin. You already have the margin. 1/4 of these goods remained unsold the year end. So at the year end, have a closing inventory of 1/4 of 20 is 5 million, a closing inventory of 5 million, which has an amount of unrealized profit. More than that, I'm told each limited sold goods at a selling price of 40 million to A limited, reporting a profit of 10 million. Half of the goods sold to A had been sold over the year end. And more than that, at the beginning of the year, H limited had goods to the value of 10 million purchased from S limited. In the year ended 31st December 2021. So if I had opening inventory of 10 million, that means I must have also had a provision for unrealized profit. So I'll check what is the difference between the opening provision for unrealized profit and the closing provision for unrealized profit. So this will be working 7 unrealized profit on sales. I had opening inventory of 10 million. I had year trades. We traded 20 million during the year. So left with a closing inventory of a quarter of those goods, 0.25 minus 25 million. Then I'm told the margin will be the normal margin of 33%. So I can find and realize profit on opening stock and realize profit on closing stock. This would be that 2% multiplied by the opening stock. And this would also be 33% multiplied by the closing stock. And so when I opened the year, I had a provision of 3,333. But when I closed, the provision had reduced to 1,660, meaning some of this was converted into actual sales. So this would be a reduction in the provision for unrealized profits. And because a reduction in the provision is income, this will also affect my paid earnings as an amount of income. It should be this minus this. So then these were the sales from S to H. We also have sales from H to A. My sales from H to A, I was told I sold an amount of 4 million, making a profit of 10 million, and half of those goods were remaining in stock. So then realized profit is half of the 10 million. So it was 0.5 by 10 million. Again, this affects my retained earnings. So this is all very good. Then I'm told included in the trade receivables and payables into the respective companies are the following intercompany balances. We have B from H to S, which 5,000, because that becomes S, I'll have to make this amount in. So B from A to H, 5,000, this is the accounting for the amount in this one. A please check in S Limited books reveal that the receivables of S Limited had 30 million due from H Limited. This anomaly arose because H Limited sent a check of 5 million to S Limited on the 1st December 2022, but had not received by S Limited as of 1st December 2023. So we have an amount of cash in transit, an amount of 5 million. 48 cash in transit. Ordinarily, we add cash in transit to its destination. So to account for this, I'll have receivables, payables, and cash in transit. The cash in transit is an amount of 5,000. We told the receivables are 5,000, and so this must be 20,000. So that the balance of this is going to S, I'm going to 5, so that we have accounted as total reduction of 25 for sales. And that is very good. Meanwhile, all companies have paid their interest and loans of every year, and that will affect my P&L minus safety. And so I am done with my additional information. Now to conclude with some final workings that will allow me to present my statement. Working 8, working 9, my investment in associates. This would be equity accounting. So I'm going to first find the costs of investment, which I had as 300,000, but then I want post acquisition profits. So for my post acquisition profits, I'll have to use my closing retained earnings and the retained earnings on acquisition. My closing retained earnings in the associate were 407,000. From a position I had, the minus had 300,000. So that the post position profit is 107,000. But remember, in my associates, I only won 30%. So this would be 30% of 170. More than that, we want to account for any other value that has affected my investment in associates. I remember I had a goodwill impairment here, an amount of 33. This amount had already been adjusted so 90%, so we keep it in full. More than that, I have the fair value depreciation. I had an amount for S and for A. Here I need equal minus 30% of the value I found, 1570. And then finally, I have the realized profit, the sales between H and A. And I don't think there's anything else that affects my investment in associates. Give me a value of 312,569. More than this, we need working 10, the group, retained earnings. So here I'll be capturing the parent values, the subsidiary values, and the associate values. And so this I'll have the parent, retained earnings, I'll want post-acquisition profits in both S Limited and in A Limited. We also want, I'm just typing out exactly what they have in this associate. It's really likely to affect my thing. And so the goodwill impairment, this in copy from above there. I have goodwill impairment in S and in A. Let's first capture that. My parent retained earnings are an amount of 13.5. Post-acquisition profits in S, I will have a split, just like I have for A. The closing retained earnings for S are 365. The retained earnings on acquisition were 200,000. So that I have 165,000. But remember, this is the parent, and so I want the parent's share. So this will be 80% multiplied by 165. Then post-acquisition retained profits in A, I already have 1,000. Goodwill impairment in S, I want 80% of the goodwill impairment, which was 64,000. The goodwill impairment in A, I already have as minus 33. I also want the fair value depreciation to that as well. Fair value depreciation in S and in A. So in S, this will be 80%, which will have to be equal minus 80% of fair value depreciation is at 81. And in A, I already have as 451. Then beyond that, I have the unrealized profit in A, unrealized profit in A limited, which I have as 5,000. But then I also have my reduction in the provision for unrealized profit, which in this case will be a positive value. So this will be 80% of that reduction. Beyond this, I have unrealized profits on non-current assets. So this would be, I have the label here, unrealized profit on NCA equal minus the whole amount of 25,000. But then that excess depreciation, copy this with that excess depreciation will also come in here. And here I'll have the parent share and the NCI share. Then that will be it. These are all the elements that affect my retained and adding up to 1458.77. Then the final calculation, working level, which would be my NCI. So this would just be almost an exact replica of what we have for our routine, and we'll have the NCI position. Then now any amounts that I check my subsidiary S. The post acquisition profits in S, I want 20% of that equal 20% of 165. The goodwill impairment in S, I want 20% equal minus 20% of, then it has to be negative, the value of the total will be negative, so 20% for goodwill impairment. This goodwill impairment by 20%. Then, more than that, I have next thing that is fair value depreciation. Again, equal minus 20% of the fair value depreciation. Next thing that affects S is this reduction in the provision for unrealized profits equal 20% this. Then finally, I have excess depreciation, which would be 20% of my excess depreciation. So that the sum of my values should add up to 151,557. And that would be it. I can now fill in my values on the top. So for my PPE, I have my parent value plus the subsidiary value. I need to add any fair value gain that I had. I had a fair value of 50 for my subsidiary S. I need to less any of that fair value depreciation, which was 38.1. I need to less again the unrealized profit of 25,000 and then add back the excess depreciation of 9,000. That will be 30.618. Then for my intangible assets, there was no adjustment. It was this as this. For my investments, I had 11.5 plus 10. But then how much did I spend? I spent 750,000 on S. I also spent 25,000 in the loan stock of S, and I also spent 300,000 investing in A. So my investments remain at 60,000. Goodwill, I already have a closing value of 96,000, and my investment in associates, I also have a closing value for 312,559. Can add this together to end up at 35,6,177. Inventory will be, I consolidate my amount in full, but then I account for my unrealized profit. In this case, I have an increase in that provision, so I will add it back instead of lessening it. So that decrease in provision here. Trade receivables will be, I combine them, but then I remember I have an intragroup balance of 30,000 to eliminate. So minus this 30,000. Cash at bank, there was no adjustment, I just add them together. But then there was cash in transit, right? So I combine them and then I add cash in transit of 5,000. So my total assets, sum of this and this, gives me a value of 4.317 For the ordinary shares, I'll pick the parent ordinary shares of 2 million. Retained profits, I already have a final value. My book retained profits of 1458.77 to give me a sum of 34.58. For the loan stock, I combine my values in full, but then I'll remove the investment in loan stock that was made by the parent company. My trade payables, again I consolidate in full, but then I remove the intragroup balances, switch to that plus that minus 5,000. My bank overdraft, no changes. Just a simple combination. In current tax, also no changes. And adjustments should give me total liabilities of the sum of this and this. NCI, I also already have a closing value of 181.57. And so now I can find my total capital and liabilities as the sum of this 150,677 and no, not 150, 34.58, the sum of the 48, my total liabilities, and you can see. And if I have done everything correctly, my work should work. So that is it. This is the answer to the requirement. I'll see you in the next one.